Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 13th edition of Market Outlook. So, quite the move up. Let's get into some of the details. Commodities certainly looking interesting, but there are certainly other warning signs that this rally, although it seems to have continued legs, could run into some trouble. Let's take a look at where we are right now. Overall, the S&P 500 looking really positive. You had a decent rally day on Thursday with an increase in volume, but one thing to be uh, cognitive of is that the average volume during this rally has been consistently less from the lows, uh, less than the 50-day moving average of volume. So that is interesting. Now, you have had accumulation days. An accumulation day is where you have an up day and the volume is greater than the prior. But what I call a real accumulation day is when it's also uh, an increase above the 50-day moving average of volume. So you get those two factors together. And as you can see, we did pretty much get that on Thursday. The Friday follow through was marginal, right? You got a really strong up day, but you can see the volume did not exceed the prior day nor the 50-day moving average of volume. But we are now in an accumulation phase, right? 50-day moving average is under the 200, but we closed above it. What I'd like to see for the upside move is another confirmation close above this 200-day moving average. And again, the critical point uh, now is going to be just under the um, the 10-day moving average and the low from Thursday. So we're looking at important support levels right around the 197 level. That is now important support. Obviously, intraday, if we start breaking beneath the 10 and the body of the candle from Thursday, that could also be another warning sign that this attempt at the 200 has failed. So that's more around the 199.50 level in the S&P. So that covers the S&P. Um, let's take a look at a couple of other things here. For instance, um, gold, GLD. And what's interesting is even during the rally in uh, this month and the mid part of last month, look what's happened to the price of gold. Generally speaking, gold is a great factor in an anxiety index, but even as the market should have been telegraphing to gold that the flight to safety should not be underway, gold has held up rather nicely. Now you did get a little bit of a sell-off on Friday, but again, take a look at this overall pattern, and you can see that you just moved into a bullish phase with the blue, the 50-day moving average above the 200, and trading well above it. Now, there's a couple levels of important support to note. Certainly, the first one is the low from Wednesday of last week. That is an important pivot point, and that comes in, let's see here, that's going to come in right around uh, let me get some more detail here. Right around 118.80 or so. That's an important point to know. The other really critical support level comes in quite a bit lower, but that's around the 114 level here, right? That's the support that should be afforded by this level here that comes in right around the 114 level. So if we break the level I just pointed out there, right around that 119 level or 118.80, or so, then you get support down to that 114 level, and that should really hold. On the other hand, all this consolidation over the past week and a half or so, a breakout to the upside would give it plenty of power to move. Now, let's go to some market internals, and we're going to go to the Market Gauge website and Little Big View. So you can always find it under Resources, Little Big View. So let's see what that's telling us. We're going to look at some sectors and, in general, just a overall market overview here. So as you can see, U.S. indices still down on the year. NASDAQ leading to the downside, down almost 5%. Dow down 1%, and the S&P just under 1%. Now, what's interesting, as we noted, there are more accumulation days, so that's a positive. We got 4 accumulation days in the Dow. That was a pretty smart rally here off the lows, and you got some 3 accumulation days. Now, remember, these are what we call the classic accumulation days, where you just need an up day on greater volume than the prior day. Now, what I was talking about earlier was yet another confirmation where the up day has to have greater volume than the 50-day moving average, and that has not occurred. So that's like another level. So overall, volume patterns are okay, but not extremely favorable, but still more positive than negative. We flipped from distribution to accumulation in the last week. So that's a net positive, but again, not totally in gear. Let's take a look at the sector summary and see what that's telling us as well. So now what's happened here is we try to look for at least 3 or 4 groups that are above trading with a positive 6-month positive move, and in fact we do have it. But notice, one of the things I had pointed out was utilities is the leading sector in all of the S&P 500. That is very interesting, because usually when that occurs, it's a cautionary sign for the market in general, right? People are looking for steady yield, utilities give it, and to take risk assets off the table. So this is an unusual scenario where utilities are still leading sector with the market moving up as well. This is cautionary. So with gold still way outperforming the S&P, utilities as well, this is where we're looking at the market may still have some more legs to the upside. It looks like it has momentum, but overall, the bigger picture is that there is still a pause from the general investing climate because of the strength in utilities. Now, the other net thing of interest in terms of sector analysis is that the next strongest sector is the XLPs, the consumer staples, on a 6-month basis. So the fact is, consumer staples, again, a relatively risk-off type of play. So your top 2 sectors are risk-off plays as the market's moving up. So again here, very, very mixed. Now, what is promising is semiconductors and technology are picking up pretty close in pretty close proximity to the leading sectors that we just pointed out, including the semiconductors, where they're just basically neck and neck here. So semiconductors, technology, and even the industrials are starting to pick up nicely here. So that's sort of a positive sign. I would really be watching those semiconductors and the technology stocks and see if they start gaining relative to utilities and some of the other sectors that I just mentioned, like the consumer staples. Now let's go to the market internals and see what they're saying. So if we look at up-down volume in another format, you can see, interestingly enough, that the up-down volume in the S&P 500, as the market's been going up, has been trailing off. So you definitely got to overbought levels, and if anything, you can say that the up-down volume here definitely showing some signs of weakness, right? Overbought, flip now under the overbought zone. That is definitely cautionary. Overall, the McClellan oscillator, which is looking at an intermediate term advanced decline picture, is still positive. We're sitting above overbought levels, but still not really hooking down where you can say there was a bona fide early sell signal. Now, in terms of the shorter term advanced declines, still looking very strong here, right? We're sitting at pretty high levels, and even as the market's moving up, we're holding it. We're holding up rather nicely. Certainly not trailing off, which would be a definite negative. So 2 out of the 3 here holding up rather well. So for the moment, market internals not looking too shabby in terms of up-down volume and advanced decline. All right, let's take a look at our next chart. And this is a view of NASDAQ. Now remember, NASDAQ is down 5% for the year. Interestingly enough, even as you made a new closing high over the last, actually, I think it's also a new closing high for the year for NASDAQ as well. No, not quite. No, so NASDAQ has not made a new closing high for the year. It's lagging. So what's interesting, you can see NASDAQ got overbought, generated a signal here to the downside, very similar for its intermediate term advanced decline, otherwise known as the McClellan oscillator. That's a negative, and the advanced decline on a shorter term basis also hooking down. So even with NASDAQ closing pretty well on Friday, but the overall weakness is still apparent, and the market internals definitely weaker on NASDAQ than the S&P. So S&P looking pretty good, looking like it can still, on a rally, gain against the NASDAQ index itself. All right, let's take a look at a couple of other charts here. I'd like to take a look at the new high, new low ratio, and as you can see with the S&P just really exploding, that's a really good sign. Things are in gear regarding a new high, new low ratio. So not surprising that that with this leading index, that the confirmation here, looking at the internals and the new highs, new lows, is performing well. So that is a positive sign. So net net, you're looking at some real positives here for the S&P. Let's go to take a look at another chart. Again, this is the NASDAQ 100. And again, we can't even get above the 50% level here on the new high, new low ratio. But net net, after all this massive selling, once we did cross above 20 and 30, it did sort of put us in gear. And market is recovering. But again, just this points out the weaker position of NASDAQ. The relative strength across the board of all the market internals definite favors the S&P for the moment. Couple last things, and then we're going to wrap it up. Volatility. Volatility is trading at the lower end of its Bollinger Bands, under the 200-day moving average, and not quite really at an extreme level to the downside. We are just trading pretty much right at the lower part of its overall trading band, however. So with this market moving up, we're actually trading pretty firmly on a relative basis in the VIX. So that I would say lends a bit more caution is the fact that volatility has been holding up. There still is a bit of pessimism at this level that's higher than what would normally be um, considered for this point in time. All right, let's take a look at one of my favorite indicators is looking at sentiment. So as you can see, we are not really running super rich here. This is looking at short-term volatility, which is 1 month out versus 3 months. And basically, you can see that we were pretty oversold here, right at the lows here. Again, oversold here. Back up over here, you were hitting some pretty interesting points of being overbought, especially when we came back down under the 200. You can see that we were in an overbought area coming back down, and the market really got hit. Conversely here, it looks like we've resumed momentum to the upside. We have not gotten overbought. So again, there's more room to the upside here. Certainly, if you look at overall sentiment indicator, which is the volatility index, this ratio, the short-term VIX versus longer-term VIX. And as you can see, we're not yet or even really close to getting that overbought region up here. So, you can always go back to the website and see what's going on a daily basis. So use this. This is a free tool. It's great. All right, now what I'm going to do is I'm going to cover one last thing. I'd like to go into commodities, specifically cane, which is sugar. And it's thinly traded, but this is an interesting ETF because the issue of backwardation and contango issues, which is all about the first month delivery of a commodity, is sort of been smoothed out with this particular ETF. So you can see this sugar ETF got down to $8.50. We've traded now up to 1036. That's a 20% move. And even if you measure that against the S&P 500, this is a pretty good size move. We're basically attacking the levels reached back last May. But more importantly, look what we're tracing out. It looks like we're tracing out a long-term head and shoulders bottom, which ultimately would give sugar a count somewhere at around $13 or so. 12 to 13, 12.50 to 13 is what I'm looking at here. It's about a $2 move, right? If you take the neckline and count it, it's about from the shoulder here to the low right here. It's about $2 or so or more. Now, since this is relatively illiquid, but the point is that if you take the meat of it, it's trading around 8. The high here is probably around 11 or so. So, you're getting a pretty good upside count. And again, looking at this, I would say let's take a look at the longer term chart and see where some resistance may come in. And you can see the next point here is probably, well, you got two levels here. On the weekly chart, you got some pretty interesting resistance around 1382, but you'll also have some other interesting resistance in the 12 to 1250 region up in here as well. So looking at agricultural commodities, a whole consortium of them is DBA. We're holding that, and as you can see, that is now coming around out of its base, led by sugar on really pretty good volume. It's the best volume it's been in quite some time. This is going back. Let's take a look. Oh, 6 or 8 months or so, and we've exceeded or at least matched that spike in volume from a different level. So you're looking at a possibility here in DBA where first level of resistance comes in almost perfectly around the 21.75 to 22 level. All right, well, that's it for now. Hope this helps. Keep an eye on commodities, utilities, the semis for early indications of leadership. That's going to give you some good clues. Overall, the S&P definitely looks like it should have some more legs. We gave you some points on the upside where it could head to, and as well as if it breaks down and reverses course here. And again, remember, the longer term momentum has certainly broken down. So this still, the overall picture could have some more legs to the upside, but I don't see this as a runaway market. Thanks, and bye for now.